I look at the debt of the United States. I look at the asset bubbles that exist in corporate debt and commercial real estate. And I look at the asset bubble in collateralized loan obligations and private credit. I look at all these bubbles and I say they're unprecedented and they're concurrent. So through history, we've had times when there's been a bubble in the stock market.
Right.
In 2000, there was no bubble in debt to GDP. There was no bubble in corporate credit. There was no bubble in real estate. It was just a NASDAQ bubble. But that bubble burst with a recession and having the NASDAQ drop by 80%.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Michael Pento is with us now. Michael, it's been a little while since we last spoke. The stock market's going up. We should all be taking out the champagne now because our paper wealth goes up by the day, right?
Yeah. I got to tell you, the facts are that this is the most scary market. And I'm in the business 33 years, Kerry. This is the most scary market I've ever been in. And that's why I thank God for his help in creating, I think it's his help creating the inflation, deflation, and economic cycle model. Because if I didn't have a model that had me, had early warning signs of what I need to know, the arcane warning signs for when this market's ready to crack and you need to get out of harm's way, I wouldn't be able to participate in this bubble. But let's just talk about the bubble here. So this is the most narrow market I've ever seen in my 33 years. And throughout historically studying the history of markets, I mean, usually when you have markets that are just one sector, you think about, .com or Nifty 50 or AI, and that's dangerous. But when you have a market that is just really one stock, one stock, that's, in fact, I was looking at NVIDIA's percentage of the GDP of this country. It's 10%. Its market cap is 10% of the GDP of this country, and you combine that with Apple and Microsoft, the big three. It's like 1/3 of the entire country's output in 3 stocks. And then I think about the market cap of GDP as a percentage of market cap of equities as a percentage of GDP. Excuse me. That's at 190% now. It's only been higher in one instance, which was a little bit above 200% right after the helicopter money was deployed post-COVID. So just for reference, in 2007, the total market cap of equities to GDP was a bit above 100. So, we're almost 2 times higher because of all of the money they printed, borrowed and printed, I should add. And when you have a market this rally, it always ends in disaster. So just so I can wrap up this thought, you have AI and NVIDIA. That's causing people to believe, oh, the market's doing fantastic. Wow, everybody's getting, wealthy. But if you just look under the surface, the equal weight S&P 500, RSP, is up 4% this year. 4%. It's not horrible, but it is an NVIDIA, Kerry. And the Russell 2000, which is more than one stock, right? 2,000 stocks? That's down on the year. So that's when you poll people and you say, well, how are you doing in the stock market? How's the market doing? How are you doing? Well, people say, well, it's in a bear market and we're in a recession. Because if you just look at a very small, narrow slice of the market, things look great. But if you look at in reality, most of the market is down, or at least unchanged on the year, unchanged to down. And if you call up people on the phone and say, hey, do you have a job? Well, no, I don't. Yeah. But if you look at the headline figure from the non-farm payroll report, things are going great.
Yeah. Hey, the politicians have saved the market here, Michael, right? We should be grateful.
Well, I mean, I had this conversation very recently with a client, prospective client, actually. And he asked me a question. He asked me an interesting question, Kerry. He said, well, we both agree, we're in accord that, things are artificially inflated and it's very dangerous out there. And how can you invest in the stock market with any confidence? And he said, Michael, when the next crisis comes, what if they just print it all away like they always do? And I said, well, yeah, that's a good question. But what makes this time different than every other time since 1987 when the Fed decided they could just monetize away the problem after the 87 crash?
Mm-hmm.
Well, there's two things different. The first one that's different is the U.S. economy, and more precisely, the U.S. Treasury is insolvent. Insolvent. You have $1 trillion interest payments on the debt, on the deficit. Yep. You have $2 trillion deficits. You have debt outstanding that is 725% higher than the revenue that you collect every year. You have an insolvent nation. So the idea that you can just start on this massive borrowing spree to combat a recession, you risk really aggravating the bond vigilantes, and interest rates might not go down. Mm-hmm. And the other difference this time is this is for the first time since 87. The salient issue is inflation already to start. Inflation is still way above the Fed's target. 3.3% isn't 2. Its rate of change, second derivative, is down from 9. But if you look at the University of Michigan's consumer sentiment, it shows that people are very much aware that their living standards have been destroyed over the last 4 years. They're not interested in inflation coming down more slowly. In other words, let me rephrase that to be more accurate. They're not interested in having inflation going up more slowly than it was. They want prices to fall. They need prices to drop. They don't need them to go up more slowly from an already unaffordable level, which is much higher than the 2% target. So that's the problem.
It's a big problem here, and it doesn't look like anybody really cares about it anymore. The candidates, the politicians, nobody seems to care less about it, Michael.
Well, they do care. I mean, they care. They care. You know what? They care enough to write a letter. Elizabeth Warren wrote a letter to Jerome Powell, and Jerome Powell is antsy and recklessly looking forward to cutting rates again. Elizabeth Warren wrote a letter with 3 other Democratic senators say, please, start cutting interest rates now because it'll make housing more affordable. I mean, what, Kerry? These are the people we elected to represent us in Congress? You want to cut interest rates so housing becomes more affordable. What a moron. I mean, housing prices went up 50% in the last 4 years because interest rates went to zero. The 10-year Treasury was taking a 0.33% post-COVID. And that caused everybody to buy. What do you do? What do you do when interest rates are free, Kerry? You borrow a lot of money.
Yeah.
So Elizabeth, maybe your interest rate might be, and we just talked about the fact that it might not be because of inflation and insolvency issues, credit and inflation issues. Maybe your interest rate might be lower if you cut short-term interbank lending rates, Elizabeth. Mm-hmm. But are home prices going to go down if you start cutting interest rates?
Not a chance. It's
no.
Higher.
So once again, Main Street loses, and Wall Street wins. And the Wall Street crybaby. This kills me too. The Wall Street crybabies. We need the Barry Sternlichs are out there of running these real estate investment trusts. Oh, please cut rates. Go, please. It's so despicable. It's disgusting. Mm-hmm. When are we going to start caring about the average, middle class person who actually does the working in this country? They actually do the producing in this country, not the people who own assets, not the poor who are collecting welfare, the people who work for a living. Who's speaking for them?
Good question.
Kerry, who's a candidate? I'm sorry. You got me going on this. You did it. I blame you. It's me. I'm kidding. But who's a candidate out there who really has a good understanding of economics and can get up and say, we need to abolish this horrific organization known as the Federal Reserve? And, Janet Yellen's out there. She's the head of Treasury, saying that the government debt is in a good place.
Yeah. Oh, yeah. What is she smoking? What's she smoking, huh?
I mean, come on.
What place is that? I mean, hey, so question for you. The petrodollar appears to be officially dead now. What does that mean here for us?
Well, I mean, in short term, I'm looking for the rate of change of inflation to drop significantly, because I think we're headed for a recession very quickly. And I've been predicting that it's going to end up. I've been predicting that we are going to end up in another phase. So 2022, we had a recession. It was bailed out by and this is true. This is a fact. $1.7 trillion of QE came out of the reverse repo facility from 2022 till today. It's still coming out. Wow. So that's what truncated the recession. So the reverse repo facility had $2.5 trillion in it. It's now have just a few $100 billion. That's almost empty. That QE offset all the QT and then some from the Federal Reserve.
Right.
So that's what that's the liquid. That's why Roaring Kitty and Nvidia and the stock market in certain sectors is having a field day. That's why. You give Wall Street $1.7 trillion of gambling money over the course of one freaking year, and they'll go to town. And that's what they've done. That's almost over. When that happens, I think you have a liquidity crisis, repo crisis, money market crisis, and I think everything goes down except for short-term bonds, and the U.S. dollar will have a temporary bid, I think. But then you talk about the petrodollar. You talk about the dollar weakness that's going to come on the other side of this recession when they start blowing up the balance sheet again. I mean, you think about the Fed's balance sheet. It was $700 billion 2008, then went to $9 trillion. This is Banana Republic, my friend. Banana Republic style numbers. No, you can't deny that, and no one should. And then you say, okay, you got it back down to $7.2 trillion from $700 billion. That's still a lot, right? In fact, it was the balance sheet was $4.5 trillion prior to COVID.
Right, which is still getting out of hand.
Out of hand. Money supply booming. That's what's fueling all this liquidity. It's almost over, though. And you think about the recession that's going to come, and on the other side of this recession, when Janet Yellen and Jerome Powell or whoever's in charge, it'll be somebody who's going to be a puppet of the president. They are going to have an unholy union once again and unleash helicopter money. It'll destroy the dollar. And I'm not talking about the dollar so much against, the yen or the pound. I'm talking about the dollar against hard assets. You're going to see, excuse me, the people call me even on a federal holiday, as you say. You're going to see, I think you're going to see protracted stagflation, the likes of which we've never before witnessed or even dreamed possible in this country.
Wow. So in the meantime, a banana republic like Argentina is moving in the right direction, right? And interesting how Milei decided not to dollarize the Argentinian economy, and we're heading in it exactly us and the West are heading in a completely wrong direction, and we didn't even talk about China here, Michael.
Well, China is not my favorite country either. I mean, you're talking about running from the United States. You're going to run into what? You're going to run into the euro, the renminbi. Where are you going to go? I mean, they have a real estate crisis there. It's not going away. Clearly, the problems are not interest rate related. People can't afford a house. The real estate crisis in China is worse than the crisis in the United States. And we have a massive real estate crisis in the United States. Yeah. People can't afford their home. People can't afford a home. And you throw in the 50% increase in home prices and then coupled with the 26% increase in maintenance costs and insurance and taxes associated with owning a home, unaffordable. we have a dysfunctional real estate market here, frozen. So, I'm talking about the dollar's destruction against hard assets. Once, not now. I wouldn't do it now because I think the dollar can still have one big move higher yet. Because that's what happens anytime you unwind carry trades, global carry trades. People run into the dollar.
Yeah.
So I would be a long dollar. Not now. I'm neutral a dollar. I don't have a position in it. I would get ready to get a position in the dollar and then short the heck out of it in the aftermath of the Great Recession. I'm not going to call. I think I've called this the Greater Depression.
Yeah.
That's what I think is going to happen because. And Kerry, why? Because I'm some kind of maniac who has no idea what he's talking about, or I'm some kind of Cassandra who uses hyperbole. No, I look at the debt of the United States. I look at the asset bubbles that exist in corporate debt and commercial real estate, and I look at the asset bubble in collateralized loan obligations and private credit. I look at all these bubbles, and I say they're unprecedented. And they're concurrent. So through history, we've had times when there's been a bubble in the stock market.
Right.
In 2000, there was no bubble in debt to GDP. There was no bubble in corporate credit. There was no bubble in real estate. It was just a NASDAQ bubble. But that bubble burst with a recession and having the NASDAQ drop by 80%, 83, I think. And in 2007, there wasn't really an equity bubble. But there was a real estate bubble, and that didn't stop the S&P from dropping by 50%. But now you have a credit bubble, real estate bubble,
student loan bubble, auto bubble, got bubbles as far as the eye can see.
NVIDIA bubble. I mean, there are bubbles everywhere you look, and they're concurrent. In other words, existing simultaneously together. What do you think is going to happen when they burst? And there is no real, like this gentleman I was having a conversation with, my prospective client, there is no perfunctory response that's a salve that's 100% effective that will remediate the situation. Oh, let's just cut rates to zero, borrow trillions of dollars, and we'll monetize it all.
What could possibly
try it and see what happens. See if
what
that
could possibly go wrong. So we're going to have to have some type of debt jubilee here, either voluntary or involuntary, right?
Well, you're talking about debt jubilee. You're talking about the restructuring and canceling of debt.
Yeah.
That's. I mean, I don't see that happening voluntarily. It's going to be. Well, let's just be specific. I think after we go through stagflation, hyperinflation that we've never before seen in this country, when that becomes such a problem that restructuring and canceling and bail-ins, which are very deflationary, become preferred to the hyperinflation. In other words, when everybody assents to the idea that we know that we have to change, everybody's on the same page, then there will be bail-ins and debt will be canceled and debt will be written off. But you're talking about people all coming to the common, the zeitgeist will be, I prefer to have a real depression short term because this hyperinflation is killing us.
Are we going to have a referendum? Do you want hyperinflation or do you want a real depression?
We'll see. I'll take both. I'll take both. Because
have both.
Because you have both. I mean, that's this third choice. Unfortunately, it's not really a choice. You look at every country on the planet who has gone through this. Unfortunately, that's why I call the United States now. It's heading towards banana republic status.
Sure.
When you have debt and deficits out of control that have to be monetized by a central bank, you end up with, this is replete throughout history. You end up with a hyperinflationary crash, and then then you have depressions. Now, I guess the best thing we could ever do is end up like Japan, which is a chronic case of no growth, a protracted perpetual recession. And by the way, their stock market is down after 35 years of their space. So if that's the best case scenario, I think people need to call their money manager, their favorite broker, up and say, what's our plan here? What's the strategy going forward if this is where we're headed? Is it just buy and hold because the market always comes back? Well, I'm approaching retirement, and I'd like to participate in bubbles, but I don't really want to have my retirement plans divided by 2 or multiplied by 0.5 and wait 15 years and hope they come back to even in nominal terms. It's not really a retirement strategy. But we have these, target date portfolios, and these auto rebalancing. Everybody's piled into the same thing, and this is not new, Kerry. This is a disaster. It's going to be horrible. Getting the timing as close to possibly correct is the challenge. But it's better than just say, yeah, I'm long in Nvidia. Yeah, just close your eyes.
So, hey, your words just reminded me of a quote by Bernard Baruch, who said, "I got rich letting the other guy make the last 10%."
Wow, very profound and very true. Yeah, we're close. We're close to that. We're close to the breaking point. There was going to be an epiphany here soon, and I'm tying that to when the reverse repo facility runs out of its QE. So right around, I thought it would be already, but that seemed to plateau. But we're running out of liquidity, probably, I would say definitely before the end of the year, but should be sometime this summer that you could start seeing fireworks erupt. Wow. And it could be sooner rather than later.
I wrote an article maybe 6 years ago. Yeah, it must have been right before the last election, called "The Emperor Has No Cortex."
The cerebral cortex.
Yeah, he's got no cortex. And that goes for any of the presidents. It wasn't specific, but this one has a particular allure to it. Now,
well, when an independent, supposedly independent third party says you're not competent enough to stand trial, you're guilty, you're innocent for reasons of
lack of capacity,
incapacitated mentally. But that makes you a great candidate for a re-election. I mean, I'm laughing, but it's really sad. It's really very sad.
Yeah, this is like pissing me off. I just Googled "The Emperor Has No Cortex," and I see a few people have stolen it from me.
Oh, no. Well, that's, what they say. Imitation is the greatest form of flattery. So
well, I'm flattered, I'm sure. So, hey, how does crypto or kleptocurrencies fit into this whole scenario? Is that a safe haven, or is it just like anything else?
For me, they don't, because I mean, they've been corrupted and co-opted by Wall Street. And so if their prices are predicated on them shoving ETFs down your face and saying, here, buy this cryptocurrency through our ETFs, that means when the liquidity crisis hits, people will be dumping ETFs and their shitcoins as fast as possible. So no, you're not going to get zero ballast in your portfolio from cryptocurrencies.
Okay. But so when everything crashes, though, and the digital dollar is basically turned into vapor, if you're holding currency, though, that could be okay for a little while, right?
So the 4 horsemen of the economic apocalypse have cash, short-term short-term treasuries, the U.S. dollar, and shorting the market. So those are the only 4 things that will work. The only 4, because everything goes to a correlation of 1 when you have a liquidity crisis.
I'm going to have an artist make up that diagram, the four horsemen of the economic apocalypse.
Yes.
And I'll give you credit for it.
Thank you. Yeah.
So short-term treasuries, but this is only a short-term fix, right? In the
it's a place to hide when everything collapses. You need a place to hide. I mean,
Right.
you could just because you're not going to get any early warning signs from Wall Street. They're not going to get on the TV and tell you, or Janet Yellen or Jerome Powell. No one will tell you the truth. I don't think Joe Biden will either. I don't.
If you knew it, yeah.
And he's not going to tell you, hey, listen, I think we're headed for a recession that could, metastasize into a depression. So I would sell everything you have right now. Get into cash. That'll never happen. And you're not going to hear it from your friendly neighborhood money manager either, because you don't be bothered with this. He's off at the golf course. He or she is off at the golf course trying to raise the next $1 million for the AUM. So you want to be with someone who's at least looking at this, not a panic, not a perma bear, but someone who's looking at, what? I noticed financial conditions are tightening, and I noticed credit spreads are starting to widen out, and I noticed the reverse repo facility is out of whack, and I know that the move index is blowing out because the volatility index for bonds is getting unruly. I think I'm going to maybe raise some cash and starting to sell some of these high beta exposures, and just maybe go into the four horsemen for a while. See what
maybe fifth horseman is gold and silver.
If there is a fifth horseman, it would be gold. It wouldn't be silver, because silver has that base metal component to it. So it is tied to it. Silver does best when the global economy is expanding and we have inflation. So its monetary hedge is working, and it's hedged to
industrial use.
Industrial use is booming. But gold has a much lower volatility profile than silver. So I would use gold, but even in a liquidity crisis, physical gold will get hurt. It depends on the intensity of that liquidity crisis. So I'll measure and map that process as well. But right now I'm only long gold.
Mm-hmm. Yeah, understandable. So, but they call silver the poor man's gold, right?
Well, I'm not a poor man, and I don't. And thank God, I'd rather own the real thing if I don't have. It's not poor man's gold. They can call it what they want, but if you look at the performance of gold versus silver, especially when it comes to economic crises, you'll want to own the real thing, which is 100% money and has no exposure to the rate of change of economic growth.
Okay, I'll buy it. I see your point. But I think as massive panic that's going to take place, they'll be buying everything, even copper, Michael. They're even going to be buying copper.
I would not disagree with that but I would say that would be after the recession takes place. It would be on the ex post the recession, and then I would buy. I will be buying copper, base metals, and energy, precious metals. That's only after that these maniacs in Washington are able to reliquify the financial system.
Tell us how you really feel. Tell us how you really feel about it.
Yeah. I mean, you have an inverted yield curve that's been inverted for the longest duration in history.
Years.
I mean, you're killing the bank. The banks are finished, and they're under a lot of pressure from their assets that are eroding. So their margins and they call it net interest margin, NIM, is under a lot of pressure. So, listen, Kerry, I'm not a nefarious individual. I want the best for this country. The country is in desperate need of a recession. That's what it needs.
Purification.
It needs the cathartic, cleansing, purging action that comes with resetting all this debt that's not supported, cannot be supported. Resetting asset prices. That's wonderful. It would be nice if people could actually buy a house. It would be really wonderful, right?
So let's go back to the gold to Dow ratio. So once upon a time, 200 ounces bought a house, right?
Mm-hmm.
200 ounces or 100 ounces. I don't remember what the number was exactly, but basically, house was 100 grand and, or 50, and you had, 100 ounces of gold. You could buy a house with it, but not the case anymore.
So how prices are, way out. Gold, if you look at home price to income ratios, they're at the highest point by far in relation to any other time period, even 2006, which was the previous bubble peak. So home prices cannot be afforded by the income. And if you look at all the other factors that are a part of a house, like I said, the maintenance costs, the insurance costs, taxes, it's even further out of reach. So yeah, so I would look for that ratio to come back into some, economic symmetry, historic symmetry soon, and it would probably do so by both the home price coming down and gold going up.
Yeah. And the gold to Dow ratio, it's also, even though the Dow isn't really the best,
now,
but
look at the gold to NASDAQ ratio if you want something really that shows how out of whack everything is. So,
yeah. So all these ratios are going to reversion to mean eventually, right?
Reversion.
Yeah. So you want to be. You can never prepare for the inevitable. Like we buy life insurance, but that doesn't mean you're ready to die. You can't really prepare for this tsunami. It's because it hits the U.S., then it means it's global, right? It's every country in the world, except for some countries that are kind of off the grid.
Yeah, right.
Well, global, let's go.
If you take the problems that are extant in Europe and the United States and China and Japan, those are the countries you have to be concerned with as far as, your portfolio. What most people are concerned. If you have problems in those four countries, you're not going to be safe anywhere.
Yeah.
I don't think you're safe anywhere.
And it's one black swan could set it all off, right?
I don't think we need a black swan. We need the regular white side. It's every, like we just said, it's not, I don't think we need some kind of rare exogenous meteor hitting the earth. It's going to be the same thing. It's a business cycle. We took on way too much debt. Interest rates were near 0% for 10 of the last 14 years following.
Which was awful.
Following the global financial crisis. That's the problem. And people borrowed too much money when money was virtually free and asset prices went to the moon. And now inflation is coming down and money supplies has been shrinking. And the liquidity spigot is about to run dry. And you'll see this correction. It's just part of the business cycle. We don't need anything crazy to happen. And when the stock market starts going down, there's in the 5 quintiles of consumers, the bottom 3 are done because inflation has wiped them out.
Right.
So the top 2 is all that's keeping things afloat, and their wealth is in real estate and stock speculation. Gordon Gekko. And and they're about to get a reality check once the liquidity runs dry, because when the stock market begins to fall and the real estate market begins to tumble, guess what? All 5 quintiles will be crying for Uncle Jerome and Aunt Janet. Please, Elizabeth, please cut interest rates, please.
And that'll be the worst time to do it.
And cutting interest rates. We talked about it already. Cutting interest rates back to 0 when you have an inflation problem, and borrowing trillions of dollars when you're insolvent.
Yeah,
like 130% debt to GDP.
Nuts. The stock market is
in a prosperity, in a soft landing. We have that condition. Ridiculous.
The stock market's kind of mirroring the debt market, right? The stock market's 190% of GDP, and how much is debt times GDP? That's kind of like a definite correlation there, huh?
We're getting there, unfortunately. Not good.
Well, we always appreciate you coming on. Go over to pentoport.com. The link's in the show notes. Questions, comments for Michael, myself, KL@kerrylutz.com. While you're at the site, sign up for your free newsletter. Michael, we'll talk to you again real soon. Thanks.
Appreciate the time, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now. more than ever.